Welcome back, everyone, to another episode of Let's Talk Housing. My name is Brennan Thomas, the co host here, alongside the Stephen Thomas, chief economist and founder of Reports on Housing. Today, we will discuss the most recent news and statistics, luxury market, spreads getting worse, jammed housing market, and just so much more. But first, like usual, what's going on in the large Thomas household?
It was a hard week, actually. As we all know, my mother passed away last Wednesday evening, and that I my number one person in my life is my wife. My number two person in my life is my mom, and she touched everybody's hearts with love. She was the most loving person out there, and I like to say that she had a fast pass to heaven. So I know that she's no longer in pain, but that doesn't remove the pain in losing someone that was so beautiful, even though she was definitely she's in a better place now. So that's what's going on with us. So in the midst of that all, we're trying to we decorated for Halloween over the weekend, and because I still have a 6-year-old that wants to enjoy the holiday season, so we decorated for Halloween, and Halloween's coming up this Thursday, and life continues to churn. But yeah, definitely a struggle fest for the Thomases, you included. So I'll ask you what's going on in your neck of the woods, but go ahead. Let me know what's going on with Brennan
I mean,
Thomas.
yeah, it's been about the same for me. It's just been a harder sort of week. And the good thing is that we were able to spend it with so much family and so much love, even just being around where she was at the time. And even after with your brother's birthday and everything, it was my uncle. Um, it was just nice to at least be around some comforting love and just in a good place, knowing obviously where she is, like you were saying, 'cause she had definitely had a fast pass to heaven. There's no question about that. But other than that, yeah, just pretty much same old for me. Just been a pretty chaotic week, but looking forward to what's coming next. But first, Stephen, what's been happening in the real estate world with supply, demand, and our very own expected market time over the past 2 weeks?
Well, you can really, or we're coming to the sense there. You could see that inventories are about to peak out, and they're really late. We should have peaked a long time ago. For many markets, it's July or August, or others, it's August, September. We're well into October, and we're about to hit November, but we're starting to see the peaks occur. And if it doesn't, even if this isn't the peak, it's for sure peaking within the next couple of weeks, because now we're too close to Thanksgiving and the holiday market. We transition to the holiday market, and then all of a sudden, a whole bunch of homes are pulled off the market without success. And then the fewest number of homes come on the market in December and January. So we'll see definitely, we'll see the inventories fall, and they'll fall pretty rapidly once we get to the holidays. And demand it was going up a little bit because of that flirting with low rates, but now we're seeing demand reverse course, and we're seeing demand continue to ebb down. In many markets, it's been the overall expected market time. That's the true speed of the market. It's not days on market. It's expected market time. It's based upon supply and demand. So what we were seeing during the fall is we were having inventories go up and demand going down. So we were having the expected market time, the speed continue to slow. But right now it's kind of flat. Some markets going up a little bit, others just flat. We're not seeing continuing going down, but flat to slightly up. And that's where we're going to have to see where we go from here. There'll be plenty of economic news to come, but that's kind of what we're seeing in the marketplace right now.
So, with elevated rates since 2022, has the luxury market behaved any differently?
Yeah, you would think that the luxury market would not be swayed by higher rates, but when we have higher mortgage rates, we have higher volatility. And when you have that higher volatility, you get some trepidation. So it kind of like ekes its way into the luxury marketplace. And I was speaking in Monarch Beach today, and nice area just south of Laguna Beach, and there there's a lot of luxury properties there too. And I just was scratching my head wondering why so many people come on the market the second half of the year in the luxury department when it's already a slower market to begin with. Why would you want to place your home on the market when it is really slow during the second half, and the further we go, the slower it gets? So my thing is, luxury, if you're going to come on, it's definitely towards the springtime when it's matched with better demand. So, and that's kind of the way it's been behaving lately since the run up in elevated rates. Is the second half of the year has been more of a struggle for luxury, and like all of the other markets, it's been better during the springtime. So it kind of matches up well with that. So that's kind of what's going on with luxury since rates have spiked.
And what has happened with the economy over the past couple of weeks?
Yeah, we started off this month. October is just a horrific month for rates, and I've talked about it so many different times. But you really need to take economic numbers, with a grain of salt. This overreaction thing gets really old. We did this overreaction thing in May. Or in March, in April, which was a reflection of all the data from March. So that was our April of this year, and that's where we had interest rates scream all the way up to 7.5%. This month of October was like last October, a lot of really strong readings, starting off with a really hotter than expected jobs report. I think there was like 335,000 jobs created. I mean, that's a lot more than this month, but even this was a big. This was a big number compared to what expectations were. We had retail sales that were up. October of last year, same thing. It's just one economic reading after another, and that most recently, within the last couple of weeks, it was retail sales. And then there was a bunch of, there was not a lot of economic readings. And when there's that much of a pause in economic readings, these different investors, their heads go all over the place. They're not grounded in fact or economic data or in any kind of quantitative theory or trend lines or anything like that. It gets into the speculation zone, and that's where we get these big extremes in the market. My big argument right now is that the bond market and interest rates, which are mortgage-backed securities, are undersold. There's definitely that people have been selling them off, and there's the rates have been going up, and it's just going to entice people to jump in as soon as we start getting any readings that are south of expectations. They're less than expectations, which definitely can come. It did last year in November, at the very beginning of November. November 3rd was the first jobs report, as we're going to get another one of those job readings this Friday. We're recording this on October 29th, and Friday is just a few days away. And we're going to see something that we could see less than expectations like it was last year. And then all of a sudden you have rates that are coming down a lot faster. But that's because people have been overselling, and now they're ready to buy these bonds as soon as we see that. So that's kind of what's been going on over the course of the last couple of weeks.
The spread has worsened by over 30 basis points in the span of a month, causing rates to have jumped from like around 6.2% to today, which we are recording on October 29th, the Tuesday. It is at 7.03%. I don't know how we got back here. It is absolutely crazy. But what has contributed to the spread enlarging, and what can cause it to shrink?
Yeah, so what contributes to it, you were saying 6.2, shoot, the day before they pulled the trigger on the half-point rate cut, which was, more than a month ago, but we were at 6.1%, 6.11, and it's come all the way up to 7.03. We've almost got a full percentage point in such a short period of time. It's absurd, the wild swings that's going on within the bond market as well as mortgage-backed securities. The problem is that once these rates started to go up, and then they were further with speculation, went up even further. And we saw that with the no news that I was talking about. There was a lot of political posturing and wondering where we should be after the election. So there's all these different things that were occurring all at the same time, and that's how. And then as rates get higher, now all this anybody that's connected to the mortgage side of things, they're really leery of interest rates coming back down, and then they have the same problem of there would be a lot of people that would be able to refinance really fast. Because if we're at 7, we were just at 6. You can imagine that getting down to 6 wouldn't be that hard. So they want a premium for it. So that's what added to the spread being worse. So interest rates actually, if it was the same spread that it was, when it was at 6.11%, we wouldn't have interest rates above 7. But the spread it began to worsen as we had rates go up at such a giant clip. And usually when we have the bond market going up, when the bond market's going up and we have interest rates that are going higher, that's when everybody likes to play in equities. But when it happens this catastrophically fast, which for no other reason than ridiculous speculation and things like that. What's happening is that even the stock market gets a little wary, and they go, "Wait a minute! Now the cost of money really went up quite a bit, so now it's not as rosy as we thought." And then they start selling stocks at the same time that they're selling bonds, and that's not a normal kind of a market flow, and that's just from this big overreaction in the month of October. We did it back in April, and here we did it again in October, and we did it in October of last year, and we did it the October of the prior year as well. This is the third October in a row, which makes October a very spooky month for mortgage rates, and I can't wait for Friday for November 1st. Let's get this October done.
Yahoo Finance released an article showing 6 ways to get around the real estate lock-in effect to purchase a home. So, Stephen, I'll stop with each one and give you a second to reflect and respond on each different point. So the first one was to get creative with fixer-uppers or land to build on.
Yeah, so the lock-in effect that they're talking about are these people that are enjoying these very, very low mortgage rates that are fixed, and they don't really want to trade it in for something else. And maybe they don't want to become landlords either. So getting creative is a way of doing it, but we're not going to get a ton of creativity that's out there. Let's be real. We're not going to get the creativity comes once we have rates come down enough and it convinces enough people to then participate and place their home on the market. That's what we've already seen this year. There's been more homes come on the market. If we would have stayed at that 6% level with duration, we would have seen more homes come on the market. And if we would have just had one negative report, that jobs report was a less than expectations, we could have actually been below 6% into the 5s. So that's not a case that was not plausible. It definitely was plausible. So this buying a fixer-upper and land to build on. Yeah, I mean, I'm in California. There's not a whole heck of a lot of land to begin with. A, B, there's other places across the United States to do all that stuff, but there's not that many people. People don't want to go through the hassle of trying to go through getting tradespeople through or finding land and having a general contractor build the whole entire thing. Not everybody has the wherewithal to do that. A lot of people want to pull the trigger and it be done. So I mean, there will be some people that is an answer to it, but it's that would service such a small percentage of the existing number of homeowners that are staying because of their low mortgage rate.
So another point is to build an ADU.
So there you go. I've actually heard this before, but what are you gonna do? If you build the ADU, you could build a nice small ADU and rent out the house or something like that. I don't know. You could do something along those routes. There are some people that are doing it, but it's been done in California. It's been incentivized. People are able to do it anywhere, and it's really not moving the needle much. It's not causing a big churn of activity. So yeah, that is a solution, but it also is not going to move the needle.
And another point was to tap into the equity of your home. So do a cash out refinance. What do you think about that?
So you do a cash out refinance. Well, first of all, you're doing a refinance to current to current rate. So there's other ways of doing this with a different equity line of credit or something along those lines. So yeah, maybe you get an investment property. I don't know exactly how you'd be able to you could do these tapping the equity to go purchase something else and then go buy. And once you find the right house, then you go sell your house. That's also I just don't see it moving the needle either. The real answer to this is lower rates. It's these are different workarounds, but it's not going to do a whole heck of a lot. It's basically an article for clicking on and not coming up with too many real meaningful solutions that a lot of people can tap into.
So you already answered pretty much two of the other bullet points, but one fun one that I figured I should throw in there is to explore distressed properties. I mean, wow. In 2024 that they're bringing this up. I'll let you speak on this.
Yeah. It's like I was doing that presentation in Monarch Beach, like I told you, and I was talking about Orange County, the true number of homes that are available that are short seller foreclosure. And it went up drastically from 2 weeks ago, went up from 5 to 7. Now, percentage wise, that's huge, but 7 total foreclosures and short sales available in all of Orange County. And it's like that in pretty much most markets. Yeah, there are some markets that have a few more, but yeah, that is a place to hit, but that's also looking for fixer uppers and things like that. It's like diamonds in the rough, and there's still not a lot of homes that are available. So all of these things don't move the needle. If it was me, there's another one that I would look for, and that is trying to find a VA seller, because if somebody bought a home with a VA loans are actually assumable, and if they have a low rate on that VA mortgage, with their VA mortgage, that's assumable, and then you'll have to get a small second to make up the difference of what you're buying. So that would be a solution, and it's not even on here. Shoot, that would move the needle more than any of these other ones that they've just mentioned.
Awesome. Now I want to switch back over to bond yields. Can higher deficits put upward pressure on mortgage rates and bond yields?
So yeah, this is one that actually kind of like threw me for a loop. That's one of the reasons why we actually have mortgage rates that are higher and bond yields that went up, is because there was some guy on Wall Street. It's just this guy that's head of a hedge fund, and he's basically telling you that this is going to be a problem, a major problem after the election. And what he was trying to do, and you have to be very, very careful who you listen to on Wall Street. They're not economists, they are traders, they are investors, and they're going to try to sell their position. His position is don't buy bonds. So that's what he was trying to sell. And he got on CNBC, he got on Yahoo, he got all over the place, and actually was able to move the needle on the bond market and on mortgage rates. And nobody should have that much power. A, B, you shouldn't listen to somebody like that. They're going to over exaggerate the nuances of it. Is it a problem? Yes. Is it one that is here right now that is going to up right now, and all of a sudden we're going to get big spike in rates, and it's going to be all downhill from here. United States is going to become insolvent. That's not even close to what's going on here either. So he was just trying to sell what his position was, and there are other traders that are trying to do the same thing. I listen to a lot of what these traders have to say because I want to hear what they have to say, so that I'm not operating in a vacuum, but I understand the nuances behind the meat of some of these rises recently, which means that it's very easy for it to go the other direction, because right now, like I said, we're oversold in bonds, and this storyline is one of the storylines that was created from this one guy coming forward, this one investor, this one hedge fund operator.
Redfin CEO states that the Federal Reserve's recent rate cut had a psychological impact on real estate, which led home sales surging by 2.5% in September when rates dropped all the way down to 6.11%. They also said how people will try to lock a rate on a Friday before it goes up on a Monday. Has there ever been a market this elastic to mortgage rates?
With the giant turns, I can't recall of one recently, and it just tells you that 6% rate is so incredibly important. Yeah, there definitely was a a change, an impact on the real estate market, even being at those low levels for a week. We were below 6.5% for a little bit longer, and that's really the threshold of where we need to be, is below 6.5% for duration. And duration is not a week or 2 weeks. We were below 6.5% for 4 weeks. That's still not enough, but it did show us that yes, there is an absolute psychological factor to getting into the low sixes, especially if you threw in a point at 6.11% or even a half a point. You were below 6%, so you had rates in the fives, and the builders have been able to demonstrate that when they pay so many buy downs, and that gets rates down into the fives, even when we were at 7 or 7.5%, they were still able to pay enough buy down the rate so that it would be in the fives, or they were even in the fours there for a while. And that just shows you that, and then it created a ton of demand. So we already knew it was there. We know what the consumer wants. So when we were there, it kind of whet our appetite for, okay, this is what it's going to be like when we're here for longer than a minute. It'll be good. It will be the thawing of real estate, because real estate has really been gummed up and frozen. And the only way to unfreeze it is for rates to come down. And then we'll have more buyers and sellers transacting, which is good for the economy, which is good for everything. And it's not me having my pom-poms out cheerleading on this real estate industry. Instead, I would like to see more transactions take place, because it's good for the economy. And you know what? More people that have been sitting on the sidelines, what they need are lower rates to allow them to get in. So that's what I've been rooting for. And that's what drives me. I go to church every Sunday, and I was telling everybody, I don't care what religious affiliation you have, hit your whatever religion you are on, and make sure that you're down on your knees and asking for this thing to change, because it's been hard for anybody connected for real estate for a long period of time, including buyers that have been waiting on the sidelines for a very long time for this to change. So that's why I've got my pom poms out, and I was very pleased to see rates down in the sixes and see such a big giant change. And as far as this, the lock-in effect on a Friday before a Monday, maybe that's been a recent phenomenon. I don't get it, because it all depends upon when releases are made anyways. This jobs report's coming up Friday, and if it comes really negative, you could get a big giant surge downward in rates, and that might be a really good day to lock. Just happens to be on a Friday.
So similar to what you were saying before with the large changes when you were at 6%, September existing home sales fell by 3.5% year over year to the lowest level since October of 2020. U.S. home sales are on track for the worst year since 1995. I mean, wow. If rates drop back down to the lower sixes, can we correct some of this slowdown?
Slightly corrected. We already have, because we could see our pending sales metric, as well as across the United States, pending sale metrics are actually up. So this was more of a reflection of, if it closed in September, we're looking at July and August in order to close in September. So that's when rates were a bit higher. Rates came down, so there's going to be a little bit of a reprieve, but not much, because keep in mind, these better rates lined up when? During the autumn market. And that's too late in the year. If we had these better rates earlier in the year, instead of above 7%, which they were stuck from April to July, they were stuck up in the sevens, and 7 just is not good for the real estate market. And we're back up to 7 now, again, right now, as of today. We'll see as this week progresses and we get to Friday what really happens with rates. That's going to be extremely important to watch that. But right now, we just need for the spring market to line up better with rates, and we didn't get that in 2024 at all. Hopefully it happens in 2025, so that more people can then purchase and pull the trigger, and more people could place their homes on the market. So that's really what it's about. But we don't have enough runway left for there to be a meaningful change for the rest of the year.
Now, I do not like to point any fingers and blame anyone, but can we say that the Federal Reserve jammed the housing market? In the 80s, we saw soaring mortgage rates, but today we have extremely elevated housing prices and high mortgage rates, making a nasty combo.
Yeah, and it's all relative too, because back then at the beginning of the 80s, we had a big surge from the early 70s to the 80s of home prices, a giant surge. So it was a big, meaningful change, as well as matched with interest rates that doubled and got all the way up towards, gosh, they were at like 18% there for a minute, kind of like our 8% interest rates last year in October. So yeah, that when they do that, their whole purpose is to slow down the economy and to reverse, put a giant squash demand a bit, so that prices don't continue to outrageously go out of control. And that's what they were doing for inflation back in the 80s. That's what they were doing in 2022. One of the little branches, offshoots, as a result of this, is it froze the housing market completely, and which they were okay with, because and then at the end of the day, what we're seeing finally is there's more and more homes that are coming on the market and accumulating, so we're finally getting a bit of an inventory. But the inventory, this is not going to fix the inventory crisis at all by any stretch of the imagination. But yeah, at this point, it's still frozen until the Fed continues to ease, and based upon them being so data dependent, everybody is overreacting to every data point, which we saw in October, and that's why we are where we're at today. And now we're back up at 7% interest rates, because shoot, the spread got worse, everything else got, and all these economic numbers and all these mortgage servicers and everybody connected to mortgages are worried that everybody's going to refinance down the road. So the cost of money just got a lot more expensive. That can reverse course really fast. So hopefully that starts, knock on wood, this coming up Friday with this next jobs report.
Something that I found interesting was written by Lance Lambert, of course, super amazing guy. You should give him a follow on X if you haven't already, where he said the drop in mortgage rates during the late summer and early autumn hitting 6.11% served as something of a natural experiment. We got to see how markets will react with lower rates. So, what did you notice with inventory demand and expected market time during that short little window that we saw of a bright future?
Yeah, so it was 1 week at really low rates at 6.1%, knocking on the door of 5%. We could actually, I could tell you that at that point, that rates were actually artificially too low. They should have probably been up a bit higher from where they were at, but which means that bonds and mortgage-backed securities were overbought, the positions on them. But it showed us, definitely, it was a great experiment, that even we're down there for a week and we were able to write reports in many markets where we had this big bump in demand. And not all markets saw it right away. Matter of fact, some of the markets were late to the party. It was after the rates had already come up a little bit, and you're scratching your head going, man, they're a little late. But nonetheless, it just shows you that if we were there for a long period of time, we in such a short period, we had 4 weeks at below 6.5, a week at the lowest level, and we saw a bump in demand. Inventories were like flat. So if you have this big bump in demand and inventories flat, we actually saw a big giant change in the expected market time. That's our speed of the market index, and it actually got a lot speedier really fast. And some markets, it was like eye-opening what a change it was. So, and that's just a minute. We were there for a minute. I've always said that we got to be there for duration. Duration's not a week. Duration's not a month. If we were there for, months, you can definitely see a definitive change in the marketplace, and our market will definitely change regardless of the timing of year. If we get down to those levels, you will see a rekindling of activity.
Redfin pulled a study on potential home buyers and found that 23% of buyers who are likely to purchase their first home in the next year said they're waiting until after the election. I mean, I don't even know what to say, but Stephen, what are your comments on that?
So we've actually dug into our metrics, and you can't really see any kind of change in the metrics for midterm elections, presidential elections, and we did our metros. And John Burns out of Newport Beach, who that economic outfit actually services new homes industry, And they did it across the United States, and they found no statistical ability, nothing that statistically shows it. So I'd be really interested to peel off Redfin's study, find out exactly how this survey worked and all that stuff, because there's a lot of nuances that go beyond behind a survey. I should know from my quantitative economics background that this either wasn't specific enough, or there's some fallacy in this reporting, because there's not going to be all of a sudden some deluge of first-time homebuyers that are going to enter the marketplace after the election, which occurs next week. I could tell you this: that if we had rates that dropped and all that jobs report at the beginning of the month was less than expectations, and we had interest rates that dipped down into the fives, yeah, I can guarantee a lot of those people that said they're going to wait have more to say with, yeah, they want to wait to see when rates finally come down a little bit. What they're really, they've got 1,000 excuses, but what they're really focused on more than anything else is the cost of money, where rates are at today. So that's really what they're saying in me reading between the lines. And I could probably do the same survey and use rates and probably get a more definitive answer to what they're looking for, rather than trying to get clicks and talking about a presidential election of which we can't find statistical data that supports any of what they're talking about. And I saw something that came out from Keeping Current Matters. It's a great outfit. I met with their owners and the people that are running it, and they do a great job. But they did something also in the presidential election, saying the year after the presidential election, most of the time it's a much better year. We've already forecasted it to be a better year, and has nothing to do with the presidential election. It has to do with rates, and rates are going to dictate what happens to next year. And every single year that they put on there was a reason that the following year that we actually had a better real estate market, and it did not have to do with the presidential election. That's just a nuance where it happened to line up over and over again. But there were times where it was negative, and I know why that they were negative, because of the circumstances of the times as well, and one of those being 1980. So, you have to be careful what you hear, be careful what you read, and sometimes these surveys and studies and all that stuff, just because it happens to be happenstance and all that stuff, may not really be what's really happening behind the scenes into the numbers.
Well, thank you everyone again for tuning in to another episode of Let's Talk Housing. If you want to learn more about what's going on in the real estate industry across Southern California, Bay Area, Phoenix, or even Vegas, feel free to check out our YouTube or subscribe today at reportsonhousing.com. As usual, please leave us a good review. We'd greatly appreciate it. And if you have any questions at all, feel free to post on any of our social media platforms, or you can email me personally at info@reportsonhousing.com. We will see you soon, and have a fantastic rest of your day. Thank you.
Thank you.